Ken Boy with Accounting Accidentally. This video is called Massive AI Investing and Depreciation Expense. So let's talk about this huge investment that's going on in AI. So this article says visualizing big tech companies spending on AI data centers. This is the engine that drives AI and more AI capabilities. So it says just how much are companies spending on data centers. This is just the period from January to August of 24. Microsoft 20 billion in chips, 20 billion in other AI spending. Google, 14 billion in chips, 15 billion in other AI spending. Tremendous investment, right? Meta, Amazon. So what are they investing in? One of the things they're investing in is NVIDIA's GPU chips. NVIDIA designs these chips and outsources the production of the chips, but you'll hear more about GPUs, which are the large pieces of data that used to get AI going. So when you see Amazon, Meta, and these large companies investing in chips, many of them are chips that are designed by NVIDIA. So how do we account for this AI investing, this AI spending? Well, let's look at the matching principle first. The idea that we match revenue earned with expenses incurred to produce revenue. So if you make a pair of blue jeans, we match the sale of the blue jeans with the labor and material expense we incurred to create the blue jeans. So we match revenue and expenses. Same thing is true here. In this case, fixed assets are used to generate revenue. So OpenAI, for example, is going to get subscribers and other users to pay for AI eventually. Same thing here. Depreciation expense, however, is recorded as a fixed asset is used up, which is another way of saying it declines in value. So think about your car. Your car might be fully depreciated after 5 to 7 years, as an example. So we're talking about any sort of fixed asset, including investments in AI, GPUs, and the physical places you create to store and house and cool these devices as you use them. So how do we do this? How do we do depreciation expense calculations? Well, two things really. We decide on the asset's useful life. Your car might be 7 years, your home might be 30 years, commercial piece of property might be 30 years. What's the useful life? And secondly, how the asset will be used up over time. Straight line, for example, means same amount of depreciation expense every year. An accelerated means we use up more of the asset in the early years, less in later years, and there's other methods to do it. So this is the basics of how you figure out how to recognize an expense for all that AI spending. So let's talk about three methods of depreciation. So the first is straight line that I mentioned just earlier, which is we recognize the same amount of depreciation equally each year. So simple example, the cost of an asset's $50,000. Salvage value is what we get when we sell the asset at the end of its useful life. $10,000, the difference is $40,000. We depreciate over 10 years, meaning that annual depreciation is $4,000 a year or 10%. 10 times 10, 10 years, you get to 100% of the value. That's straight line, the most common. Another one, a little unusual, is activity-based depreciation. Depending on how much you use the item, and a good example is a piece of machinery that is used to make units of a product. How much of the total units that you think you can produce in a particular year determines the depreciation expense for that year. So same thing here, costless salvage value that you saw up here, 40,000. However, this time we're looking at it in terms of units. We're going to produce 10,000 units over the life of the asset. That means depreciation per unit is 4 cents. So if you have a year where you make 40,000 units, we multiply 40,000 units times 40 cents, not 40 cents, and we get $16,000 of annual depreciation in that year. And that is going to vary based on how much production you do each year. The third example is double declining balance. And this is a little complicated, and it's based on the straight line method you saw a moment ago. So we compute the straight line rate as a percentage. Let's say that straight line was over 4 years or 25% a year. We're going to double that. So 25% a year each year becomes 50%. Hence, that's the double and double declining balance. So then what we do is we compute annual depreciation each year and a new book value Book value means cost less accumulated depreciation. So, for example, we start off with a book value of 270,000. We multiply that by 50%. Our annual expense is 135,000. So our accumulated, that means our total depreciation expense recognized is just the first year, 135,000. You'll note that we have a new book value in year two, which is original book value less depreciation expense. It's 135,000. Again, we multiply it by 50%. We get 67,500. We get a new total accumulated depreciation for 2 years. And so you keep going with that pattern until your depreciation gets down to the salvage value, because once it gets down to salvage value, you're going to stop depreciating, sell the asset and get cash, which is the point that I make down here. You would always sell the asset and get cash at salvage value. So those are three methods of depreciation, and there are others. And these AI companies that make these big investments are going to have to choose a depreciation method. So the takeaways here are companies in AI are making massive investments in capital. Those capital investments are eventually going to have to be expensed to reflect the revenue that they're going to generate. And these companies are going to have to choose a depreciation method to depreciate the assets.